So we have the chapter 10, the last example. It's opposite, okay? The market rate only 8%. But for any reason, your company pay 10%. Maybe just want to attract people, I don't know. Right? But the result is, okay, eventually this issue will relate back to the economics, to the course or subject of economics. If the market rate is only 8%, that means everyone put 100,000 into the bank only receive 8%, 8,000 every year. But for any reason your company truly will pay 10% and very stable, no, not too much risk very low, your company will fulfill. And the result is investor jumping in, right? Investor from all over the world come in to purchase your bond. And you know your bond is not unlimited, your bond is limited, right? So if the investor all around the world come in to buy your bond, you know the result is the price will push higher, just like in other merchant. Okay, demand higher than supply, the price will be pushed up. So that's the first step is, do the first steps. How much higher can be pushed? We know from the theory of economics, we know supply demand. From this theory, we know the price you issue of this bond will be pushed higher, but we don't know how much. So again, same thing. The first step is we need to calculate how much money your company will receive. Okay. So that is on my page 529. This is called premium. Same thing, okay? We calculate what is the present value of 100,000. Again, we use market rate. Okay? So that number is 0.6806. And also you can go back to the back page, A-1. Everybody, if you really want to, you can find out what's the present value based on 8% for 5 years. For 5 years, okay. On the page A-1. Yeah, 0.6806, right? And same thing. What's the present value of the 5 payment based on 8%? This also on the A-1, the same page. 3.9927, right? So we found out those two numbers from page A-1, right? Same steps, just like case number 2. But here it's easier to understand once we went over, the analysis, right? So right now we calculate the two number here. The only thing is the annual interest payment still based on 10% of 100,000, right? Because on the market you only need to pay 8,000, but right now you overpay. All right. So we have two numbers together, 68,000 plus 39, almost 40,000, almost 49. Okay. So you put it together is 100,798, almost 8,000 more, almost, and that is called premium. Right? And then every year you just follow like the case 2. The only thing is you have every year deduct because you have 8,000, almost 8,000 divided by 5 years, right? And that is let me see what's the amount. by the way, premium is also under the liability. Okay, premium is also under the liability. So we have every year your company did pay 10,000. However, right now your expenses is not 10,000. Okay, because the market rate is only 8%. So your interest expenses is only 8,400. Why? Because you need to divide 8,000 by 5 years. There's almost 1,600. Almost 1,600. So that is from your premium. So this case is totally opposite. Even though your company pay 10,000 cash every year, however, only 8,400 counted as interest expense, and 1,600 is almost like payback, almost payback to the premium. You cannot count as interest expense because interest expense should be based on 8% market rate. All right, any question? Anything so far?
These two cases, which one is better?